Welcome to the Farms.com Risk Management Market School video series. As always, you can find us at www.marketschool.farms.com. This video series is being brought to you and sponsored by DeKalb Brand Seed to educate producers on how to do a better job of commodity marketing. My name is Moe Agostino. I'm a Managing Commodity Strategist with Farms.com Risk Management. So welcome. And today we're going to start, this is part one of part two series where we're going to talk about industry jargon and terminology. We're going to basically define these terms. These are the most common terms that you'll find, whether you go to trade shows, presentations, or maybe you're reading something online, or perhaps you subscribe to a market newsletter of some sort. By understanding the most common industry jargon and terms, you'll be able to understand what it all means, have better knowledge, and therefore how it can apply to your marketing plan. So let's start off, and this is in alphabetical order with at-the-money call and put options. Basically, that's where the exercise price of that call or put option is the same as the market price of that underlying asset, commodity, or futures price. And you can also see in the money or out of the money. You can go back to lesson number 19 at marketschool.farms.com, and we've covered this before as well. Backwardation is an inverted market in grain market terminology where the nearby contract is higher than the first deferred contract. When that spread between the front and the deferred contract gets wider, the commercial is getting more bullish, and vice versa. It's largely because supplies are usually tight and they're trying to ration demand. They're saying basically, don't store into the future, I want your grain today. For example, if the March contract reform is $7, the May contract is $6.95, and then the July contract is $6.90. You can also see inverted market as well. Basis, the difference between the cash or spot price of a commodity and the price of the nearest futures contract. Cash price minus futures price equals basis. Basis is usually computed in relation to the futures contract next to expiry and may reflect different time spreads, product forms, qualities, and locations. You can go back to lesson number 14 and through 17 where we've talked about basis in more detail. Bearish simply means the expectation that future prices are going to fall. A breakaway gap, this is technical terms when we're looking at daily, weekly, or monthly charts. A chart formation in which prices gap out of an area of congested trading, often signaling the start of a major market move. What follows are runaway gaps, and then the last part of that move is known as an exhaustion gap. It's the last gap signaling the end of a down or upward trending market. You can also go back to lessons number 20 to 22 for more information. Bullish simply means the expectation that future prices are going to rise. Buyback, closing out a short hedge by buying the previously sold futures contract, usually to offset a physical cash sale. So you've either shorted futures, you're going to buy back that position, or you've gone long futures and you're going to offset that long futures position by basically offsetting it. Call option. A contract that gives the buyer the right but not the obligation to establish a long futures position at a specified price known as a strike price by exercising the contract at some point in the future. You can also go back to lesson number 19 for more details. The buyer pays a premium for the right, and the premium is the maximum loss that could be achieved until the decision to exercise into a futures contract is made. For example, a livestock producer could buy a call option to protect against an unexpected price increase in feed costs such as corn or soybean meal. Cash crop producer could also buy a call option to offset a physical sale in the hopes that maybe the price will continue to rise after that physical sale. In either case, if the price falls, the call option would expire worthless, but it would benefit the livestock producer with cheaper feed, whereas with the cash crop producer, the initial cost would be subtracted from the net price of the physical sale with a net lower overall price. Carry, the price structure of a particular market when the further out contracts trade at a progressively higher level. In other words, the first deferred contract is priced higher than the nearby contract. The carry is influenced primarily by supply and demand conditions and is indicative to producers or commercial elevators to hold grain for future use or sale. In other words, the market is paying the producers to store grain. It covers insurance, storage, and interest. For example, December corn is priced at $5.95, March corn is priced at $6.15, and May corn at $6.25. The carrying charges, the cost of storing a physical commodity over a period of time, including insurance, storage, interest on the invested funds, as well as other incidental costs until it is sold or delivered. It is a carrying charge market when there are higher futures prices for each successive contract month. If the carrying charge is large enough to cover the cost, it is called a full carry. See also carry. Cash market, a market that allows the seller to make delivery of his goods or services and receive that day's price. See also cash market or forward cash contract. Commercial, an entity involved in the production, processing, and merchandising of commodity and has an underlying cash position that is using futures market to hedge against, example, a grain elevator or an ethanol company. CME, Chicago Mercantile Exchange, is the world's second largest exchange for futures and options on futures such as agriculture products and is the largest in the U.S., trading involving mostly futures on interest rates, currencies, equities, and stock indices. See lesson number 1 for more information. CFTC stands for Commodity Futures Trading Commission. It's a group that basically monitors positions of various market traders like index funds, managed money. Go back to lesson number 1 for more details. Contango, we've already briefly talked about this, a market where the forward or futures price is higher than the spot price, also known as carry. The first deferred contract is priced higher than the nearby contract. Contango, that is getting smaller, narrower, indicates commercials that are becoming more bullish, while that which is getting wider indicates commercials are becoming a little bit more neutral or bearish. For example, contango will exist in January soybean futures if that futures price was $9.80, March was $10, and July was $10.10. For commodity futures contract, contango markets considered normal, as there's typically a cost to carrying or holding a commodity. In the marketplace right now, there's very little carry, whether you're looking at beans, corn, or wheat. Dead cat bounce, a brief recovery from an extended oversold decline or fall in prices, also known as a bear market, before the market falls again. So you get a market declining, all of a sudden stops, you get sort of a little bit of a brief rally, and then it stops again and continues that fall or bear market. Deferred contracts, future contracts for months beyond the nearby months or spot months, so they're the further out months. See also nearby contracts. Deliveries, future contracts that are held into the delivery period are subject to delivery. This means that those holding long positions will be required to take delivery of an actual cash grain in one of the designated delivery locations, while those holding a short position will be required to deliver grain to a designated delivery location. Forward cash contract, cash market, transaction which a seller agrees to deliver specified cash commodity to a buyer at some point in the future. See also lesson number 10. It differs from a futures contract in that the contract side, product specification, and delivery date are set between the buyer and the seller, as well as the price. This is not being standardized by the exchange. It's negotiated by the parties of the trade. First day notice, the day that the futures contract delivery process begins. That's why when you do a futures first, hedge to arrive, or a basis contract, and the elevator calls you at the end of the month, around the 28th, for example, corn futures, 10 to December corn futures will expire around the 15th of December. Elevator will call you just in the final week of November to say, hey, you got to make a decision. So it's because that first day notice that day futures contract delivery process begins, you have to make a decision to either roll forward or flatten out that contract. Long position holders who maintain their positions on and after the first day notice, usually at the end of the month prior to the following month of the futures expiration, may have to accept delivery of the underlying asset from the seller of the contract. For example, December corn futures will expire around the 15th of December, as first day notice is around the 28th of November. That ends our part 1 of defining commodity market terms and jargon. Again, understanding some of the most common terms that the industry uses is important. Knowing how how the industry, your industry works is half the battle. Understanding a lot of the terms is the other half. It can help you get one leg up on your marketing plan. Thank you for spending some time again today with us, and we hope that we've shed some light on commodity market terms and jargons defined. The next and final video will be part 2 of commodity market terms defined, and then that will be the final video for 2012. Thanks for watching. If you have any questions, discussions, feel free to email me or call me at the email and numbers provided below. Until next time, take care.